Another earnings season is quickly approaching. Estimates eyeing a fifth straight quarter of year-over-year earnings growth for the S&P 500. That's according to FactSet. For new investors looking to get in on the action via options, we're looking at beginner trading strategies to consider. And Yahoo Finance's Jared Blikre joins us now with more for the Options Pit, sponsored by Tasty Trade. Jared.
Thank you, Josh. Let's get down to brass tacks with options. Quite simply, they're financial contracts with a buyer and a seller, whereby the buyer has a right, but critically not the obligation, to buy or sell a stock at a predetermined price. Now that's called the strike price, and it also comes with the condition that it all happens within a specific period of time. Now we've had options that expire each month for decades, and now we have weeklies. We even have some dailies. So the bottom line is the universe of options is expanding. And before we dive into the mechanics of the trade, let's talk about the decisions you're going to be facing. First, which stock are you betting on? How do you feel about it? Bullish or bearish or neutral, like Switzerland? What is your strategy? Are you looking to hedge your bets, or do you just want to generate some income? And you also have to consider volatility. How crazy are the actual swings relative to what's been priced in and forecast by other options traders? And lastly, don't forget the clock is ticking. Expiration dates matter for options. And finally, there's the strike price, or the make or break number you're betting on. Now, before we go any further, we got to talk about risks. Options can be a roller coaster. They use leverage, which can magnify both your wins and your losses. So that's the fun part, and also potentially the scary part. Complexity, there's a lot of math, and you really do need to understand the Greeks. That would be delta, gamma, theta, vega. They're beyond the scope of this discussion, but there's some homework to do there as well. Time decay is another one, and that really gets back to that ticking clock. So time is not necessarily your friend if you are an options buyer. But there are a few benefits to options. Leverage is not only a risk, but if you let it work in your favor, it can be a huge benefit. It's all about controlling a large trade with a small amount of money. Then there's hedging, which is a fancy word for insurance. Options can be your safety net if things don't go as planned. And unlike other types of trading, options can let you define your risk. No guessing games. You can control how much you lose, which means a lot for peace of mind. Now it's time to get real. And we've got two main instruments with options. We got calls and puts, and you've got two potential moves, going long and going short. Going long means you've got the right to buy a stock with a call, or you've got the right to sell a stock with a put. Now you flip that to go short. And now we're talking about obligations when we're shorting. You must buy a stock if you've sold a call, and you must sell a stock if you sold a put. And that also depends if your magic strike price is in play. So let's take a deeper look at a single option. When you buy a call, you're buying the right to own 100 shares. And 100 shares can be a pretty high dollar amount. And that gets back to leverage. The key factors and numbers you need to pay attention to are the expiration date, that strike price that you're aiming for, and also the premium that you pay upfront if you are buying an option. If the option expires worthless, that's called out of the money. You lose a premium as a buyer. If you're a seller, you pocket that premium up front. Now let's bring it home with a real-world example. Let's say I'm bullish on Apple stock over the next few weeks, and I see right now it's having a hard time getting over the $230 price level. It's trading right now at about $227. So I think it can run if it just punches through $230. So I buy an Apple 230 call with an October 18th expiration. That's the third Friday of the month when we have monthly options expiration. And that means there's lots of liquidity in these things, meaning I can get a fair price. So I pay $3.03 per share, or $303 for the total privilege, which is my total defined risk. And that's the red shading on the chart right there. If Apple stock is above $230 on October 18th by day end, I get the profit over $230 multiplied by 100 shares. So 240 means $10 of profit multiplied by 100 shares for a grand total of $1,000. Not a bad deal. If Apple stumbles, I eat the $300 and live to trade another day. Hopefully.
Hopefully indeed. Thanks, Jared.
Thank you.